A lot of people like to go day to day and they see a story and think, oh, this is important or this is important. In fact, there's a far bigger wave that's pushing gold. It always has. And that is the ongoing degradation of the money units. Whether you're yen, euro, dollars, whatever, they continue to degrade in real buying power because it increases supply dramatically decade to decade, about 90% for the US dollar every decade. So, when your granddad built the house at $4,500, now it takes the same median price home $450,000. That's called the degradation of money. So, it shows up, gold holds its value versus that ongoing degradation. It is money, period. And so other markets will also tend to try to follow the degradation of money, like stock market. But gold always, over time, continues to hold its value and outpace those other assets. And therefore, the interest rate issue. If the economy weakens, yes, the central bank will then have an excuse, justification to put full throttle on it again. They're always got their foot on the pedal. I mean, they're always printing money. They're always, money supply expands. Interest rates are arbitrarily set by a central governing body. It's the most essential commodity in human interaction between you and me, or me and somebody who makes a product in China or somewhere else. I don't know who they are. Don't meet them. But I like what they do. They like the money, okay? But if what we're transferring back and forth is degrading in value, sometimes quickly, if you're in Venezuela, for example, or Weimar Republic, you get the point. But governments deem that they have the right to control that essential commodity, quantity of it, the price of it, interest rates. And so you have a manipulated, effectively socialist money. And so wise men from above are deciding, and when they see an excuse to, print, they do, and they go crazy. Since 2009, actually it was October 2008, the Fed went to QEs. They took a chapter out of the Japanese book, and they started to go berserk, and they kept the 15 years since, 16 years now, interest rates were effectively at zero 10 of those years. And even when they raised rates during that time, and if you go back 50 to 75 years, you'll see that Fed funds rate was still in the lower quadrant of history. So they manipulate the money, and that's what causes gold to go berserk. And therefore, this data point that we saw today is merely another little excuse for them to go berserk. And, Powell to finally give in to the other voices on the Fed and to the president and all this stuff. Print. So gold knows that. That's why. Simple as that. It's a broader issue than just day to day.
Yeah. So in one of your recent reports, you showed that that the market may be turning over at some point, and typically what happens is the Fed comes in, they print money, they save the markets in this boom and bust cycle. And so in your recent report, you said this time it won't work. And so I wanted to get your perspective there and dive into that a little more.
Well, in fact, it never really does work, because once they help create a boom through usually monetary policy, and you can see it in the money supply or the interest rates, so forth, stock market will participate and enjoy the party, And then when the stock market tops, ultimately it's overdone reality for a certain period of time. It's overshot any realistic level, and primarily driven by monetary policy. And it breaks. And when it starts to break, reality takes over, and the Fed can't stop it. They never have been able to do that. You go back to .com, and that peaked. It was a laborious stock market top. It wasn't like a top and a collapse. It was for a year. You toyed around between January 2000, 2001, sideways. Made people feel comfortable. And in January 2001, about 6 months after the top tick in the S&P, they cut rates twice and continued to cut rates all the way down to 2002 low. Yet during that time, NASDAQ 100, representing the .com, dropped 82%. So they didn't protect anything. 2007 to 9, same story. They cut rates surprisingly. It was an ambush. September 2007, market went up, poked a new high right after that. Marginally, but made a new high, all-time high, in fact. That was the top. They cut rates all the way down, market went down anyway. And it's going to happen this time. The only difference is if you stand back and look at 1994 to 2000, 2002 low to 2007 high, the duration was much shorter, usually 3, 4, 5 years. And the multiple gain in the S&P, for example, is usually double, maybe triple, maybe a little bit more. But duration and multiple gain, there's no comparison this time. You go back to the 2009 low, and we've got a 10-fold advance in the S&P over 15 years, and we've got a 20-fold advance in NASDAQ 100. So dimension-wise, it's far bigger, duration-wise far bigger, meaning far more errors have been built into the system because of the distortion of the money unit. And in this bull bubble, we never had rates at free money, 10 of the 15 years, and low at the other years, lower than normal. And then the money supply also expanded rapidly. So you can understand why the bubble occurred. But once it breaks, reality tends to take over, and the Fed can take out all the hoses they want and turn on the spigot, and it just won't help. The money will go elsewhere. Where does it always go? Gold.
People often get caught up in the news cycle. They read a story, hear a pundit, and think, this must be the key. This is the data point that explains everything. But the truth is that day-to-day headlines are noise. They may move markets on a tick chart, but they don't explain the tidal wave underneath. And it's that tidal wave, the constant grinding degradation of money units, that drives the real story. Whether you're talking yen, euros, or dollars, the pattern is the same. Every decade, 90% of the purchasing power is destroyed. That's not a theory, it's arithmetic. Your grandfather built a house for $4,500. Today, the median home price is $450,000. Same wood, same bricks, maybe a little better plumbing, but nothing to justify a 100-fold increase except the fact that the money unit has been debased. That's what the polite economists call inflation. I prefer a more honest phrase, the theft of purchasing power. Gold, on the other hand, doesn't inflate. It doesn't change. It just sits there as a measuring stick, reminding us what's happening to everything else. Now, central banks don't like to admit this. They want you to think that they're masters of the universe, setting policy in a sober, rational manner. But what are they really doing? They're manipulating the most essential commodity in human existence, money. They decide the price of interest, the cost of using that commodity. Imagine if a committee in Washington set the price of bread or electricity by decree. We'd call that socialism. But because they wear suits and talk in jargon, people accept it. It's centrally planned money, and it's every bit as fragile as Soviet breadlines. Since October 2008, when the Fed unleashed quantitative easing, the manipulation has gone parabolic. They took a chapter out of Japan's book and went berserk. Interest rates were at zero for 10 years, and even when they weren't zero, they were still in the bottom quartile of history. Combine that with explosive money supply growth, and what do you get? A bubble of historic proportions. Stocks, bonds, real estate, all levitated not by productivity, but by distorted money. So when people ask me, why is gold rising? I don't point to today's payroll number or yesterday's CPI print. I say because the Fed has its foot permanently glued to the accelerator. Even when they pretend to tap the brakes, it's theater. The structural reality is money degradation. That's why gold holds value. That's why gold outpaces other assets over time. Let's talk about the cycle of boom and bust. The Fed engineers the boom by slashing rates and printing money. Asset markets ride the wave. Eventually, they overshoot reality. Valuations stretch beyond anything justifiable. Then comes the bust. The Fed tries to rescue the system with more printing. But does it ever actually work? History says no. Take 2000. The dot-com bubble peaked in March. The S&P went sideways for a year, keeping people comfortable. The Fed started cutting rates in January 2001. They kept cutting all the way down to 2002. Did it save the market? Number. The NASDAQ 100 collapsed 82%. Or take 2007. In September, the Fed surprised markets with a rate cut. Stocks popped to a new high. That was the top. They cut all the way down into the crisis. Did it stop the carnage? Number. The S&P fell over 50%. The point is, once a bubble is inflated, reality always wins. Liquidity doesn't save it. It just redirects the flows. And where does the money go? Into gold, every time. This time, the bubble is orders of magnitude larger. From the 2009 low, the S&P advanced tenfold over 15 years. The NASDAQ 100 advanced 20-fold. That's not a healthy bull market. That's a distortion of biblical proportions. And what fueled it? Zero rates, QE infinity, and a money supply explosion. Duration-wise, this bubble dwarfs any in modern history. Magnitude-wise, it dwarfs them too. Which means when it breaks, the Fed can open every fire hose it has and it still won't matter. The money won't flow back into equities. It'll go elsewhere. And history tells us that elsewhere is gold. Let me pause here and inject a bit of humor, because otherwise this gets heavy. I saw a tweet the other day. The Fed says inflation is under control. My grocery bill disagrees. Another one, Powell says the economy is strong. My credit card statement says otherwise. Humor aside, these jokes resonate because people feel the degradation in their daily lives. They may not use technical terms, but they know their dollars buy less.
So many years have passed that the real value of the money unit that we're measuring by, the dollar in this case, or you could do it with euros or anything else, is just meaningless. The decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200, would not surprise me. But we're taking it in segments. And my own personal investments, which we show at the end of each report, the disclaimer, are heavily in silver miners as opposed to gold, okay? Though gold is the mama, it's going up. Silver has both outperformed and underperformed gold on a routine basis over the decades. And if you go back 50 years and look at what is the highest relationship of silver to gold in any one of those given years and plot it. We have a graph we put in the latest report. 2%, meaning divide an ounce of silver into gold. Silver was 2% of the value of gold in 20 of those 50 years. So it's not absurdly, to be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11. Silver got up to 3.5 and higher price of gold. Well, right now, silver's 1.12%. Okay, still dirt cheap. It got under 1% recently, which is historically very, very low level. When you see that, buy it. But when that spread turns up, and it's been turning up sharply, well, just for example, this year, people don't realize this. Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, the spread chart and the momentum of the spread chart, which is what we look at, both technical metrics, have very clear pending triple top breakouts, meaning levels that they've stopped twice before. And if you punch up through that, these levels go back several years, by the way, you're breaking out big time. So if you looked at these charts, these spread relationship charts, and treated it as a price chart, you'd say, ooh boy, you break through that and I'm gonna blow the cork off this thing. The spread is about to do that, I think. And when it does, I think in the next handful of months between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. Well, that's a huge move because we're talking almost doubling the current relative value of silver to gold very rapidly and going up to that, quote, normal 2% level. Because we're, like I said, 1.12% right now. So anyway, I think there's a huge explosive potential in silver, coincident with the rise in gold, but advancing more so. And so that's why my personal emphasis is in the silver aspect of the monetary metal.
So obviously with gold, we see central banks buying and such. What do you think of those fundamental aspects of for silver's?
Well, first off, I don't look at it that much. And I try not to, okay, because I don't want to be distorted by a notion of fundamentals. Why? Because quite often fundamentals, even if they're true, even if your assumptions are correct, that doesn't tell you about the timing. Mm-hmm. You could be right and not be right in terms of price reaction for 2 years, okay?
People underestimate silver. They always have. It's been called the poor man's gold. And in Wall Street circles, that's practically an insult. But I don't see it that way. In fact, I consider silver the high-octane part of the monetary metals engine. Gold is the anchor. It moves methodically with weight. Silver is the wild card. When monetary stress hits, it doesn't just walk, it sprints. Let's put some math on this. Over the past 50 years, if you map silver's value against gold annually, in 20 of those years, silver represented about 2% of gold's price. That's not a freak accident. That's a recurring relationship. In bull runs, silver has even spiked to 3.5% of gold's price. Right now, silver sits at barely 1.12%. Not long ago, it dipped below 1%, which is historically dirt cheap. What does that mean? It means when the ratio turns, silver doesn't just climb, it detonates, and you can see it happening. Year to date, silver is up 42%. Gold is up 37%. Yet most people still think silver is lagging. That's the perception gap. The spread charts I track, the momentum indicators, are all flashing pending breakout. Triple top resistance levels that have capped silver for years are now within reach. When those levels break, you don't just get a nice little rally. You get a blow the cork off move. I believe that between now and the end of this year, silver could be trading in the $60 to $70 range. That's not a fantasy. That's math, history, and momentum converging. And if silver reverts to the routine 2% of gold's value, at today's gold price, that implies a doubling of silver's relative worth. That's how you get into the hundreds of dollars per ounce. And it happens faster than people think, because when spreads break, money floods in. Investors don't sit around asking if it's fundamentally justified. They chase momentum. That's how markets behave in crisis. Now, what about fundamentals? I tend not to lean on them too heavily because they don't tell you timing. Remember the movie The Big Short? Those analysts knew in 2005 that the mortgage market was a ticking bomb. They pounded the table for 2 years before the crash finally hit in 2007 to 2008. They were right, but they had to suffer in the meantime. That's why I prefer technicals. But let's not dismiss fundamentals entirely. Silver has them in spades. Photography once drove demand. Today, it's solar panels. Over 80% of global solar production comes out of China, and silver is essential in every panel. Add in silver's role as the best electrical conductor in the known universe, and you see why it's tied to AI, EVs, and the so-called green transition. Annual silver production is flat. Demand is surging. You don't need a PhD to see the imbalance. Even mainstream outlets occasionally admit it. A recent Bloomberg piece noted, silver demand is hitting records led by solar manufacturing, even as mine supply stagnates. Translation, the squeeze is baked in. But here's the irony. I don't think industrial demand is the primary driver of the coming explosion. That'll be the excuse the media uses when silver crosses $50, because they need a story. But the real driver is monetary panic. Silver is money, always has been, always will be. And that brings us to psychology. Most people in the West have forgotten that silver was once official US money. It circulated in coins, it backed paper, it was part of the system. When confidence in institutions breaks, and it will, people rediscover silver. It's not just another metal, it's an alternative to promises that are breaking down. And promises are breaking down everywhere. Think about the average person right now. They're told the economy is fine. They look at their retirement account. Maybe it's up a few percent because it tracks the S&P. That's the only thing giving them comfort, because everything else in their life is more expensive. Food, gas, insurance, education. They cling to the stock market as a lifeline. But when that lifeline snaps, when stocks roll over hard, the psychology flips from expectation to doubt, and doubt breeds fear. That's when revolutions happen. That's when institutions are overthrown. Don't think it can't happen. The Federal Reserve itself could face abolition in a true crisis. Income tax regimes could be scrapped for sales taxes. Entire frameworks can shift overnight when fear replaces trust. History is full of examples. And when those shifts occur, monetary metals don't just rally, they explode. Let's get more specific with numbers. Right now, the silver to Dow ratio implies a target of $2,676 per ounce if we revisit 1980 levels. The silver to S&P ratio implies over $3,000. These sound absurd if you anchor to today's $41 spot price. But ratios don't lie. They express relationships between assets. And in a monetary panic, it's always the derivative layers, stocks, bonds, paper promises, that collapse the fastest. Commodities hold up better, and monetary metals hold up best. That's why the ratios against equities leap so high. In 1980, it wasn't that silver went to the moon. It was that stocks cratered in real terms. We're headed for the same dynamic. This isn't a gold up story. It's a paper down story. Gold and silver are just the barometers. Let me add a little modern spice here. A tweet making the rounds recently read, "The S&P 500 is hitting highs. So is my grocery bill. Guess which one I can't eat?" Funny but deadly accurate. Stocks may be levitating, but in terms of purchasing power, they're not feeding anyone. Gold, silver, commodities, those are real. Now, I know critics will say, but you can't eat silver either. True, but you can trade it for food when paper loses credibility, and historically, that's exactly what happens. Silver isn't wealth you consume, it's wealth you preserve, and then exchange when the dust settles. We also need to consider geopolitics. Central banks are buying gold at record levels, not just Russia or China, but countries all over the map. Why? Because they don't trust US treasuries anymore. For decades, foreign reserves were parked in treasuries. Now they're diversifying. Gold is the asset they trust more than American IOUs. That's a seismic shift. And while central banks don't officially report silver purchases, you can bet that when gold moves, silver follows. In fact, retail investors in Asia already prefer silver in many cases. Walk the bazaars in India. Check the shops in China. Silver jewelry, silver coins, silver bars. They're part of everyday savings. Western investors may sneer, but billions of people in the East treat silver as money. And in a global reset, those habits matter. So where does that leave us? I believe we're on the cusp of what I call a 52-card pickup moment. The system is fragile. The average worker is stretched. Institutions are distrusted. The Fed has lost credibility. And when the stock market finally tips over, which it will, all those suppressed fears surface at once. That's when the psychology changes. And when psychology changes, markets change violently. Gold will rise methodically. Silver will skyrocket. Ratios point to levels in the hundreds, even thousands. Fundamentals point to a structural shortage. Technically, spreads are coiled for breakout. And psychologically, the stage is set for panic. Some might ask, what if I'm wrong? What if silver just muddles along at $40 to $60? Fair question. My answer, even then, it's superior to bonds yielding negative real rates. It's superior to stocks priced at 30 times earnings in a weakening economy. It's superior to holding depreciating paper. So the risk-reward skew is overwhelmingly positive. I'll close with this. In every major monetary shift of the last century, metals have been the refuge. 1933, 1971, 1980, 2008. The pattern is clear, and as Michael Oliver, me speaking to you now, has said repeatedly, momentum doesn't lie. Technicals cut through the noise, and right now they're screaming. So don't get hypnotized by the daily news feed. Don't anchor to today's dollar price. Look at the ratios. Look at the spreads. Look at history. Silver isn't just a trade. It's a front-row ticket to the unraveling of a monetary system that was never sustainable in the first place. And when the unraveling accelerates, you'll be glad you owned it.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.